Welcome to This Explainer. Today, we're diving into a massive, frankly mind-boggling financial mystery that is unfolding in the market right now. We're looking at Amentum. This is a defense and technology company that boasts these massive, seemingly unstoppable fundamentals on paper, but at the exact same time, it's suffering a massive, head-scratching stock plunge. Now, at first glance, this looks like an absolute steal, right? But as seasoned investors know all too well, a falling stock isn't automatically a cheap stock. Sometimes the market is handing you a golden opportunity, and other times, well, it's pricing in a problem you just haven't found yet. So before we can even think about deciding whether this is a buy, hold, watch, or sell, we need to uncover exactly what the market already knows. Let's get into it. All right, let's kick things off with the hard facts. $3.5 billion. That is what Amentum recently posted in quarterly revenue. When you see a top-line number of that sheer scale, it immediately signals that we're dealing with a heavyweight player. I mean, they operate across areas tied to massive, long-term government spending themes. We're talking national security, nuclear energy, space, and critical digital infrastructure.
And get this, they didn't just rake in revenue. They backed up that massive top line with a highly impressive $135 million in free cash flow during that exact same period. That means real, tangible cash is flowing straight into the business, even after all the bills and capital expenditures are paid. Plus, to top it off, management actually went out of their way to raise their full-year profit guidance. But here is the absolute crown jewel of the earnings report, the number that literally jumps off the page, an enormous $48.2 billion contract backlog. They have a trailing 12-month book-to-bill ratio of 1.3x. Basically, that means they're securing $1.30 in new orders for every single dollar they currently bill, which points to immense future demand. Honestly, a company with this much contracted work lined up should theoretically have incredible revenue visibility for years to come.
And this brings us to the core contradiction of our whole investigation. Despite those stellar numbers, despite a $48 billion backlog, and despite management raising profit guidance, the stock just cratered. It crashed over 47% from its 52-week high of around $38 down to roughly $20. Now, psychologically, it's incredibly tempting to see a stock drop from 38 to 20 and instinctively think, wow, it's 50% cheaper. But as we know, valuation doesn't really work that way. The intrinsic value didn't necessarily fall 47%.
So you gotta ask yourself a crucial question here. If a defense tech company has nearly $50 billion in contracted work just sitting there, why on earth isn't revenue exploding? A massive backlog sounds amazing, sure, but contract economics, timing, and the reality of government spending dictate how much of that actually reaches the shareholders. To solve this mystery, we have to look past those flashy headline numbers and uncover the hidden growth problem that basically terrified Wall Street.
Section 1, the hidden growth problem. Well, the market essentially figured out that Amentum's growth engine is kind of stalling out. Analysts, like the folks over at Morgan Stanley and BTIG, pointed out that preliminary 2027 revenue guidance was downgraded to almost zero, specifically just 0 to 1% growth. This was a really harsh drop from the roughly 4% expectation that was previously baked into the stock's outlook. And this stall is being dragged down by two specific issues: a 3% headwind caused by NASA bringing work back in-house, and a 1% headwind from Amentum strategically walking away from low-margin contracts.
Section 2, profitability versus growth.
Now, this leads us to one of the most fascinating financial divergences you'll see in the market today. It's a total collision of two realities. On one hand, overall revenue growth is under severe pressure and slowing down. Yet on the other hand, management actually increased their adjusted profit guidance for 2026. So what's going on? Is Amentum deliberately sacrificing low-quality revenue to build a better business? Or is the growth engine genuinely just broken? Which one is it? To figure that out, we need to apply the ultimate test. This is where the beginners and the experienced investors really separate. Revenue tells you what they sold, sure. Earnings per share tells you accounting profitability. But the absolute ultimate test of profitability, that's free cash flow. It tells us if the company's operations are actually generating real spendable money after all the capital spending is done. And looking at Amentum's latest quarter, the numbers are undeniably strong, generating $146 million in operating cash flow and $135 million in free cash flow absolutely proves they can convert their earnings into real cash. That makes the investment thesis so much stronger. But the real mystery is whether they can sustain this level of cash generation during this ongoing transformation, especially while carrying the financial burden of their past acquisitions. Because let's be real, one strong quarter doesn't automatically prove a long-term trend.
Section 3, Wall Street's valuation puzzle. Right now, the market is desperately trying to price in this exact transformation risk. And Wall Street analysts are completely divided on Amentum's future. Just look at how this breaks down. We've got 5 buys, but 6 holds and a sell. That proves the market is severely hesitating here. Now, the average target price sits around $29.58, which implies a massive 47% upside from that $20 level. But you really can't just take that average at face value. The real kicker here? Even the major institutions telling you there's upside have been quietly slashing their price targets. Listen to these cuts. JP Morgan dropping it to 26, Morgan Stanley down to 24, BTIG and RBC slashing theirs as well, and BNP Paribas, they're holding a $22 sell or underperform target. Wall Street isn't simply saying, oh, Amentum is cheap. They are actually signaling a total lack of conviction that historical growth rates will ever return. All this hesitation creates a really wild valuation puzzle. The trailing price-to-earnings ratio is sitting near 26, so definitely not a deep value play if we're just looking at the past. But the forward PE, that is dirt cheap at 8.14. So this means the stock is only a bargain if they actually hit those future earnings estimates. If earnings slip, that cheap forward valuation vanishes into thin air. Plus, remember, Amentum isn't a traditional dividend stock. You can't just buy it for the yield and wait patiently. You are 100% reliant on earnings growth, cash generation, and valuation expansion. Section 4, the bull and bear cases. Since Amentum doesn't pay a traditional dividend to cushion this wild ride, investors are basically betting on 2 completely different futures. Let's look at the bull versus the bear here. The bull believes Amentum will successfully convert that massive backlog into revenue, swap out weak contracts for high-quality profit, win shiny new nuclear and space contracts, and ultimately restore meaningful growth. If that happens, today's price is an absolute gift. But the bear argues that slowing growth, lost NASA revenue, and overall lower expectations will permanently compress the stock's valuation multiple. Basically, a company can report decent profits, but the stock will still disappoint because the market just refuses to pay a premium for it. Section 5, the final investor verdict. All right, let's pull all these clues together and figure out exactly how to approach this stock at $20. Here is your actionable framework. You're in the buy camp only if you truly believe that margin expansion and cash generation will easily outshine any near-term revenue weakness. You hold if you like the long-term defense and space exposure, but you demand actual evidence of returning growth first. You watch if you're happy chilling on the sidelines for clearer 2027 numbers. And you sell or just completely avoid the stock if your personal investing strategy requires rapid revenue growth and you're worried the 0 to 1% outlook is a red flag for a deeper structural slowdown. At the end of the day, the biggest takeaway from this explainer is this. Success here isn't just about snatching up a cheap stock. It hinges entirely on Amentum proving to the market that their strategic revenue sacrifice actually creates fundamentally higher quality, higher margin earnings. That is the ultimate trigger you need to be watching for in their next earnings report. But, Amentum isn't the only market mystery we're watching right now. Over in the tech world, why did Seagate Technology just take a 6.5% nosedive right in the middle of a massive, historic data storage and semiconductor boom? I mean, if the industry is stronger than ever, why on earth is the market aggressively selling it off?
And that is exactly what we'll be digging into next time. Join us for our next explainer as we hunt down the hidden clues behind the Seagate sell-off and figure out what Wall Street is seeing that you might just be missing. Until then, remember, in the market, things are rarely as simple as they appear on the surface. Keep asking the right questions.